All right, everybody who's on the call, thank you so much for getting on here today. I really appreciate your time. When you get on the call, go ahead and mute yourself. I'll work to have that happen on my end as well. But if I can't catch you as you come in quickly or something, go ahead and mute yourself, please. So that way that we don't interrupt Cindy in her presentation. So today we're going to go over how to dissect operating agreements and PPMs. So that's something that I experienced quite a bit of questions on, and a lot of our passive investors have questions about, what should I be looking for? And that's not something that I can really help with because I'm not an attorney. So there's some areas that I think people should focus on. And there's some areas that I've found in my past experience overlooking documents. There's some sections that are pretty much like the same thing every time. You should review every single thing in your documents, of course, just to be educated. But if you're curious where to focus on, that's kind of what we wanted to talk about today. So Cindy, I'll give it to you.
Yeah, and let me introduce myself. I don't know if everyone knows who I am, but I am a partner in the law firm of Calliser and Associates with Merrill Calliser, and we do
Hey, Cindy, I'm trying
you
to.
don't want me muted, right? Yeah. Okay.
There we go. Okay, so let's do that
Okay.
again.
So I want to start off kind of with an overview of what passive investors basically should be looking at just in general, and then dive into a bit about the documents. And I know I want to share my screen, so let me proceed to do that. And that's not the right one. Where is it that I want? So share screen.
And if people are popping on right now, please mute yourself because I'm going to screw it up as you come in.
Okay, so but you guys can't see that, can you?
Not yet, no.
No. Okay, so where is what I want to share? Share.
Yes.
But not that, but I want this. Any good? We have it?
Yes.
Okay. So just give me one sec. Okay, yeah. So this just kind of an overview. I want to touch on what we like to call our passive investor guide. And I think it'll be helpful before we dive into the documents just to get an idea. Sorry, that's not us. Okay, so the first thing as a passive investor is we call it creating your avatar, but basically that's creating your ideal, what is your ideal investment? What are you looking for as you go to analyze whose investments or who you're going to give your money to? So the important things, and how do I get this full snow? Okay, well, I can't quite see the bottom of it, but basically, and this comes into play as you're looking and reviewing your PPM document as well, but you want to look at what cash on cash return are you seeking? What's the minimum amount you would accept as an investment return? Is the deal a value add or cash flow? That's important for your determination of whether, what you're trying to get out of it. The IRR, the internal rate of return, and the expected cap rate. How much are they asking you to invest? We see deals as low as 25,000, upwards 100,000. What are you comfortable with? Are they accepting both accredited and sophisticated investors? And what category do you fall into? How long are they planning to hold the property? What type of tax savings, if any, can you expect by investing? How large? How many doors on the property? Is it in a market that is considered a primary market or a tertiary market? The population of the area, the unemployment rate, if the population is going to grow, what's driving the economy in the location of the property. and basically the income potential there. And then how do you go about finding your opportunities? Could be people posting on social media, from friends, from some of the meetup groups or education clubs if you're part of that. And now getting into reviewing the PPM documents. So you can, if as a passive, you can hire an attorney to review them for you. A CPA can review. You want to research who the manager is, who is the GP, have they done other deals, how many deals have they managed, how many doors, what kind of relationships they have, how many sponsors are there. Very important, you know, if it's a person acting solely, do you have full confidence in that? Is it a team? And then lastly, how will you invest? Are you going to hold the investment individually or through an LLC? If you don't have an LLC, is that something you need to look into forming? Are you going to put it into an existing trust, or are you going to use IRA funds? And then basically once you, I gotta move my little thing, once you determine that this is a deal for you and the sponsor or lead on the deal has accepted that or confirmed that they would like to accept you into the investment, you need to obviously wire your funds to the sponsor. Okay. Oops. Now I want to dive into the documents and, okay. Can everyone see that? This is kind of a memo we did to kind of answer questions, which I want to share a copy of it with anyone who needs it afterwards, but let me go over it, because this is basically what we're trying to dissect here is, what do you do when you get your PPM and company agreement, and what are the hot buttons that you need to look at? Kaylee, can you see that screen?
Yes, ma'am.
Okay, good. Okay, so really the highlights, and every PPM company agreement will have different, depending on who's drafted it, what law firm has, it will look a little different. It will touch on some different things, but all should include these key points, and these are kind of the things that you really want to be looking out for. So the first one is, how are distributions handled? And that could be one of the most important things that you want to know. Basically, are there two classes of members? Most deals we see have a Class A, that's where all the investors are housed, and a Class B, that's where the sponsors or managers get compensated. And what is the split between those two classes? And that's basically going to determine how your distributions are made. What is there a preference to a certain class? So sometimes you'll see, for instance, a 90-10 split between Class A and Class B, but before Class A ever gets paid, there's some preference to Class A that needs to be met before the split can come into play. And also an important question to ask, so let's say you put $100,000 into the deal. When you're getting distributions quarterly or during operations, are those distributions taking down the value of your capital account, or are they not counting towards your capital account? And once the deal is either refinanced or sold, will you be made whole basically again? So basically what I'm saying is, let's say you put $100,000 in and you're getting quarterly distributions over time. Let's say they've made $50,000 worth of distributions and then they're ready to sell. Are you made whole at that point? Again, back to 100,000, or is your capital account down to 50,000 now? And then once you're made whole to 50,000, then the distributions come in. So it makes a difference as far as the ultimate amount of money that you get out of the deal. Second big area you want to see are how capital calls are addressed. So as the sponsor is operating the property, if there's a need for more cash, and this certainly has come into play during these recent COVID times, because in some instances, income hasn't been as projected and there needs to be a little bit of a capital infusion to keep the property going. So if there should be an area where capital calls are addressed in the company agreement. Are these capital calls mandatory or discretionary? Meaning, if the sponsor needs more capital, asks for capital, are you compelled to provide that extra capital? And if not, you're basically, your shares are kind of locked out at that point, or are they discretionary capital calls where if you can't contribute, you're not penalized? So that's an important area to look at. You want to know about voting rights. With your investment, are you acquiring voting rights, or are you merely acquiring distribution rights? Most times, voting rights coincide with the percent ownership based on how much of an investment you've made. But that's something you definitely want to check. And then what are the major things that are voted on, and what is required for their votes? For instance, is it required to have a vote of the members in order to refinance or sell the property? Is it a majority, or is it what's called a required interest? Required interest is like a supermajority, and typically that's a 2/3 vote. But again, it's not standard what that amount is, so you want to check that in your company agreement. How is a change in management handled? So everything's rocking and rolling, operations are fine, but then some glitch happens, or the investors are not happy with the management. And if that's the case, what is the methodology to remove a manager? And that is definitely needs to be addressed in the company agreement, and you want to see what vote is required to remove a manager, what happens when the manager is removed, if they're still able to retain their Class A or Class B shares, and so forth. Typically in the PPM, there's always a investment summary, business plan, pro forma included, and you want to get an idea of what the holding period is on the asset. What is the sponsor thinking? Is this a short-term deal where they're going to, sell it within a couple of years, or is this more like a long-term 10-year type hold? And if that's the case, is that something that is agreeing with your avatar, that you've determined that, okay, I can put my investment in there, I'm not, expecting the big payoff, and I understand that this is going to be a long-term type situation. Also, you want to see what provisions have been made if you need to cash out early. Sometimes things come up unexpected, and you have a necessity that you need to liquidate your investment. Is that even possible? Not always, but you want to see how that's addressed in the company agreement, and what method do you have to offer the shares first to the company? Are you able to offer them outside the company at all? How is a price set? How is an appraisal done to value your shares, and so forth? And then lastly, you want to see when will distributions start. On these deals, typically, there may be a period of time at the beginning where some rehab is going to happen. You have to get income up before distributions can start. So pay attention whether it dictates that, first distributions won't start until 6 months after ownership, or a longer period of time sometimes. But that's an important situation, because if you're anticipating getting quarterly distributions starting as soon as the property is acquired, you want to pay attention if that is not the case. And that kind of overviews the highlights. Let's see, whoops. All right, how do I stop sharing? Let's see, any help here how I stop sharing?
On the bottom, the green little arrow in the box that's pointing up, click on that. It should let you stop sharing.
What did I do? No, I can't even see anybody.
Click on the Zoom icon on the bottom.
Yeah, there should be a Zoom icon, a little camera. It's a little blue box with a white camera at the bottom of your screen, Cindy, on the toolbar.
Okay, blue box, yeah.
Okay, and that should bring back up the Zoom call. And then if you roll your mouse over the Zoom call, another toolbar should pop up saying share screen.
Let's see, it did not bring up the Zoom. You are, okay. Sorry, guys.
It's okay.
Okay.
Yay. Awesome. That is an awesome document. I'm kind of looking at some of the comments that we're getting in our chat. And for example, Harvey said, that's a great document. I'd like a copy. Cindy, did you say that we'd be able to get a copy of the presentation?
Yeah. And am I able to reply here? Oh, yeah.
Yeah, go in the chat and do privately or to all.
Yeah, we have everybody's email address that registered for this call. So what we can do, Kaylee, if you'd like us to, we can send you the presentation as soon as the call is over. And I'll send you an updated list so you can go ahead and make sure this gets out to everybody that registered for the call today.
Yeah.
And then I just put my email address in the chat box. So feel free, anyone, to email me and I can send you a copy of it as well. And, you know, if you have any questions, I can answer those.
Now, I've got a couple of questions myself. So is that technically what we did, was going through the operating documents, really?
The PPM and the company agreement, yes.
On the company agreement. Okay, got it.
Yeah, because they mirror each other. So the PPM basically, and you probably guys already know this, but I'll just say it anyway. So the PPM is basically the disclosure document that basically gives you all the warnings why real estate is risky, and do you understand that? And if you do, sign this, good to go. The company agreement is actually the document that moves forward once you close on the asset, and that is your basically your Bible of how we're going to operate this property, what can the manager do, what rights do I have, and so forth. But the documents are parallel to each other. The terms are significantly the same.
Now, usually whenever there's an offering out there, usually, and obviously that at that point, the offering documents are already kind of made up and decided. So example, for the equity split or something like that, is there any possible way to have, like, say if a couple of passives, maybe they're in a group together, or so these are passive / limited partners, and they are like, well, we'd rather invest in a deal. Usually it's predetermined, but after the documents are made, is there any point in time where anything can be renegotiated or any of that, or are they kind of just set the way they are?
So oftentimes there are circumstances that something needs to be changed. So there is possibility that an amendment to the company agreement can happen after the asset is purchased. Typically, and again, each deal is different how it's structured, but typically that requires a sign off on either that required interest or majority of members or all of the members. So depending on what the amendment is, depending on, you know, how significant it's, I mean, if it was changing distributions, that's pretty significant. So that would require all members to sign off on that.
Okay. Okay. I've never experienced that, but I always have weird questions. So
yeah, well, they're not even weird. I mean, those things definitely do come up. We've had one recently where an amendment to the company agreement, and not everyone was on board with making that change. So there's some friction now going on between the members and the sponsor.
Got it. Yeah. Okay. That's all that I have. I don't know if you are okay with doing some Q&A.
Yes, absolutely. I'm looking to see if there's any more questions, but yeah, it just looks like nice comments. So yeah, we'll definitely send the documents out to everybody for sure.
Okay. So I think it'd be cool if we could take maybe the next couple of minutes, 10 to 20 minutes, maybe, depending on how many questions we have. Right now, there are 20 participants on the video. So if anybody has any questions about what we just looked at, again, you know, for example, PPM, if you don't know, it means private placement memorandum. There's certain jargon that we use on a regular basis that, depending on where you're at in the process of pre-investing, post-investing, et cetera, you may have different questions. But yeah, now's the time. If you'll have any, please put them in the chat box and we'll address anything. We're very fortunate to have Cindy's time. She is very busy, which is good, but want to make use of it, of course.
And kind of on just to kind of piggyback off of what you just said, Kaylee, and I don't know if everyone here has looked at deals or is thinking about investing, but just to give you an idea, when you are going to become a passive investor, typically what you're going to get is a PPM package. And what that would include from the sponsor would be the PPM, the private placement memorandum, the company agreement. Then you'll get an investor questionnaire. And what that is, it's usually, in our case, it's like about an 8 to 10 page questionnaire of kind of who you are, what your assets look like, what your income looks like. And the sponsor uses that to determine if you're either a sophisticated investor or an accredited investor, and basically if you're qualified enough to be let into their deal. And then the last document that's part of that package is called a subscription agreement. And that's basically your contract with the lead sponsor of, you know, how much you're going to invest, and then they countersign it. And then basically once that's done, you wire your funds and you're part of the deal.
Oh, I guess I do have a question. So for the different, you know, we do different type of offerings. We do the exemptions, or I do the exemptions. There's other kinds, A plus, etc. It's going to change. That's why I'm asking this. So Regulation CF, or crowdfunding, is the process of looking through documents, getting a package of documents. Is that the same? And the only difference is just the accreditation, self-certification part, or is it totally different?
I think we might be mixing up a couple of exemptions. So the basic exemptions that we see and that basically are used to acquire commercial real estate are either a 506B or a 506C. And those are all part of the SEC Regulation D, basically instructions. Crowdfunding isn't used that much in these deals because you're limited in crowdfunding to the amount per investor that you can accept and the amount of total funds that you can accept. So we don't, I would say, ever see crowdfunding used in these circumstances, not to say that it couldn't be, but the other two are much more popular. So 506B is an offering, an exemption to offering where, so these are exemptions to registration basically. So it's not, if you had to go through the full-blown process of registering your investment, it would be unwieldy. So these are exemptions that the SEC has come up with. And the 506B exemption is that you cannot publicly advertise your deal. You have to have a pre-existing relationship with each of the investors that you accept into your deal. You can take as many accredited investors, and an accredited investor is someone with a net worth over $1 million and income over 200,000 for the last year, with the anticipation of it being the same for the next 2 years. So you can take an unlimited number of accredited investors and 35 sophisticated but unaccredited investors. Basically, a sophisticated investor is someone, when they fill out that investor questionnaire I spoke of, they understand the nature of a real estate investment, but they may not meet those income or asset qualifications, but they fully understand what they're getting themselves into. And kind of as a sponsor, what they look at is, okay, is this person investing $50,000 and that's the full amount of their net worth, and we take this investment and they're not gonna have anything else? Or is this just a portion of their net worth and they're not gonna depend on this? Because real estate, as we know, is risky, and there's no guarantees that you're going to even get a distribution or get your money back. Obviously, there's a lot of upside potential as well, and that's why everyone is investing in real estate and wants to get into real estate passively if possible. So, so basically, that's the 506B. No general solicitation, no advertising on Facebook, a pre-existing relationship with all of your investors, and the ability to take up to 35 sophisticated investors. 506C gives you that ability to advertise, go put it on Facebook, put up a billboard, whatever you want. You can only take accredited investors. And I will back up a little bit. In 506B, the investors fill out that investor questionnaire, and the sponsor can rely on that information and say, okay, he told me he has this net worth, that's fine. 506C, the accreditation process, determine if they're accredited, must be done by the sponsor, so that the burden shifts to the sponsor to determine, is this person really accredited? So it's a little bit more complex, but it does allow you to advertise.
And then my question with Regulation CF was just because it's going to be changing from a very limited amount to a 5 times that amount pretty soon here in the next couple of months. And so with that process, it's a different regulation. So it's not Reg D, it's a different regulation, and I've never done it. I don't know anything about it, but is it kind of the same type of process? But
it would be the same type of process, and we'll have to, and like you said, it is changing. So I think we're going to have to kind of evolve with that. And if it becomes something that's more appealing than doing the Reg D exemptions, that'll be kind of a new way to do things.
Cool. So we do have a couple of questions.
Yeah.
One, can we explain more about capital accounts from Deborah?
So capital accounts, that's basically where your investment funds are housed. So let's say the deal requires a $5 million capital raise. All the monies that are collected, let's say they're doing 50,000 from each investor, all those monies are pooled into one capital account. And then that capital account may be used for rehab on the property. Typically that's what for the down payment, the differential between the purchase price and what loan you're able to get, that type thing. But basically that's what a capital account is. And then, so the capital account, it's very intricate accounting where it's all accounting, all accounted for, so that as distributions are made, it tracks each investor's capital account, whether that is considered a reduction of the capital account as operational distributions are made, or whether that capital account stays at 100,000 the whole time. Once the property's sold, you get that 100,000 back, and then any excess is distributed based on that Class A, Class B split.
Got it. And then we have a little bit more complicated question from Anthony. Capital calls, and I'm interested on this as well.
Sure.
I haven't experienced one, but with your experience, have you seen any capital call events historically occur? I don't think this would be common, but maybe with COVID it would be forced, or we'd be tempted to use the provision. And my question to tack onto that is, if you've seen them, is there a minimum and a maximum?
So a very interesting question. There are always allowances in our company agreements for capital calls that are not mandatory, but there is a provision if that mechanism needs to be used. In my 6 years, I guess it's been as a partner with Merrill, I think we've seen maybe one capital call prior to this COVID situation. And that was a property that was just underperforming. They needed an infusion of cash and had to reach out to their members to get that infusion of cash. Now comes along COVID, everyone's, or not everyone's, potentially income has not been the same in the last couple of months. People are contemplating now what to do. Are they going to make a capital call? Are they going to try and do a forbearance agreement? Are they going to try and infuse cash perhaps out of their own funds if they're the sponsor? So people have talked a lot about capital calls recently. We haven't actually seen one pull the trigger on it, but that's kind of been like, okay, what do we do? And I think people are waiting to see. April wasn't so bad in collections. May, some had less or not as much. I guess what happens in June is going to be kind of telling whether capital calls will need to be done. But I think with this time period, we'll probably see more.
And that's an interesting point, bringing up that obviously none of us could predict COVID being a thing. And
Right.
Then normally you'd walk people down how we would handle something. And so obviously now we'll be adding that in.
Yeah.
Disasters, et cetera. But it's also been interesting how that's affected insurance, different topic, but does anybody else have any other questions? If you do, please post those in the chat. It's been really good so far. From Stephen, is there a standard form operating agreement, or are they all different?
So they're all different in the sense that they're tailored to the specifics of the deal. There are certain things dictated by the TBOC, the Texas Business Operational Code, that dictates basically how companies operate in the state of Texas. That's kind of the fallback, and always if something isn't addressed in the company agreement, we look to the TBOC for what their parameters are, which are extensive. So the company agreement is basically based on those TBOC rules, but can be changed based on your specific requirements. For instance, that required interest, that supermajority, it's typically a 2/3 vote required to do major things with the asset within the company, but that vote can be changed at the discretion of the sponsor. Sometimes, they want it higher, lower, just depending on the needs and what they foresee in operating the asset.
Good question. Let's see. If anyone else has any other questions.
Well, that's a good question.
Pre-existing relationships. Could you discuss what normally constitutes a valid pre-existing relationship, and is the responsibility for establishing the relationship placed on both the investor and sponsor equally? Interesting.
Yeah, that's a good question. So I'll hit the second part of it first. The burden is placed on the sponsor to determine if they have established a pre-existing relationship. And it's interesting because the SEC won't come out and tell us what constitutes a pre-existing relationship, but there's like loose guidelines. And we always say basically three encounters, three touches is your pre-existing relationship. And what that means is not just like a hello, how are you type thing, but an actual like three discussions, whether it's email, phone, in person. In person now is a little bit more difficult, but even a long Zoom call, but something that establishes that you actually know the person and kind of have had three encounters. Additionally, the pre-existing relationship needs to exist prior to going under contract on the asset. So that's an important point, because once you're under contract, you have to have already established all your relationships, and those are the people that you can reach out to as far as investments. And again, if you're doing a 506B, that cannot be done by just generally soliciting. So you really want to build, if you're sponsoring, the sponsor wants to build a database of potential investors prior to going under contract.
Now, while we wait for the next question, I've got a quick question.
Sure.
So when it comes to general solicitation, so for example, it's very like if I do anything, you know, even when I'm not under contract, I'm like very careful about, you know, the claims that are made or anything. It's insane, because I thought at first what I thought was solicitation meant, or ads meant, literally like if you're on Facebook or Google or anything, like paying to do ad traffic. But that's not necessarily what that means.
Right.
Ads or solicitation, I mean, it's public information, period, you know?
Right.
So I guess, could you expand on kind of what to avoid?
Yeah, so if you don't have a deal under contract, it's a little bit different, or contemplating a deal. But once you have something that you're contemplating, you don't want to make promises of returns or talk about numbers, or, you know, I expect to double your income through distributions in a year, anything like that. So no promises of any type of returns or any discussion of numbers or financials. And the reason for that is because an investor could turn around and say, well, I relied on when Kaylee told me that I was going to get a 50% return on my money, and that's why I made this investment. So the basic rule of thumb is avoid all discussion of returns, finances, anything like that. Now, certainly you can talk about why you think the location of a property is a good location, the upside in the area, the employment in the area, you know, the growth in the area, that type of thing. Why, you know, you think if you put a certain amount of rehab into this property, it's going to, you know, help increase rents. But that's more general, why you think it's a good investment type thing, versus you actually promising an investor a certain return.
Right. And you can have those conversations about returns and whatnot when you have that existing relationship, but just not.
Right. But even at that, before you've furnished them the PPM documents with all the disclosures, we always say avoid talking about returns prior to them actually seeing all the warnings of why real estate is a bad investment and why you have to be careful.
Yeah. All right. Let's see. That was a private message. Let's see. Thank you, Vince. I appreciate it. Very informative. Great. Does anybody have any other questions? I don't want to take up too much of Cindy's time, so if y'all have them, now's the time to get them out.
And if you think of something after too, yeah, feel free to, you know, shoot an email over, and we'll do our best to answer.
Yeah, of course. Massively helpful. Yeah, good, good, good. I was hoping so, because I get a lot of questions about, you know, this stuff. And I'm like, well, I don't know if it's considered legal advice if I say anything. So I just kind of don't. I'm like, just call your attorney. Like, I don't even want to.
That's prudent.
Like, I don't even want to go there. Like, you know, yeah. So actually, I would say the most efficient way I've experienced for an investor to get involved with us has been that they're like, I'm just going to have my attorney review all this stuff. And I'm like, cool. Like I just really think that's a good idea, because I think they're going to find things that would like raise their eyebrow, or they would say, is this a concern? Or have you asked them this question? And the investors that I've had the best experience with are the most educated, you know, so they understand what to look for. They understand why. They'll ask me questions. And I don't mind putting in that initial time. They'll have like, you know, 5-6 questions or something. It's no big deal. But what I find is when the person puts in that time to really understand what they're looking at, typically every deal it's similar each time. And so then usually it makes it easier for them to ride along with us and continue to invest with us, because they've already put in the time up front to understand how everything works. Let's see, Harvey. Let's see, any questions? Thank you. Contact you on the next PPM or investment I'm evaluating. I'm going to review the current ones I have or the items you mentioned. Great. And the other thing that recently, because I'm reading some crowdfunding books and some other things, as far as like putting together like a PPM or the investment documents, here's another question that people ask, you know, whenever you are maybe going from single family to multifamily or whatever. I've just gone, every time I've partnered, I've just been like, it's a security. Like, I'm just gonna, you know, do that. But recently, kind of trying to find that divide line, because I guess technically, if you have 2 partners doing something, I guess it's 2 partners or more that's considered. If one is passive, it could be considered, yeah.
It could be considered sale of a security. So it's not so much the number. Definitely, if the numbers get bigger, you're more likely to be selling a security. But even with a small number of people, if everyone doesn't have an active role in the management, then those that don't are considered passive. And if they're relying on your efforts for success in the deal, it's selling a security. So even with, you know, 3 or 4 people, and we get this question a lot, do you really need a PPM? You know, technically, yes, and our conservative answer is, if not everyone is actively involved in the management, you are selling a security. The SEC could look at it like that, and in order to cover yourself, you want a PPM.
And I was just kind of shocked at that. And you know, luckily, whenever I did like flipping houses and things, it was by myself. And you know, you hired contractors and stuff. They're not in the partnership with me. But I've seen a lot of people in single family that are like, okay, so I'm using someone's IRA and we're doing a JV, or someone is using their trust money or something like that. But essentially the other person's passive. And I'm like, I'm pretty sure that's a security, you know, because they're not doing anything but expecting you to perform. Are there certain litmus tests that you could say this is definitely a security and this is definitely not?
It's really that reliance on the expertise of another to make the deal work. So yeah, if they're passive, there's a good chance that it's a sale of security. Okay. Now, you know, is the SEC looking at every single little deal that comes through? No, but as of recent, the SEC has been cracking down on deals that have been done that are definitely the sale of security.
Yeah, I've seen that recently. So just more than ever, it's just more prudent to even be more careful, you know? Yeah. So I'm like, okay, I'm glad I did that. But, you know, for other people that are like, oh, we'll just JV it. I'm like, oh, I think it's the same thing.
Well, so JV isn't really a legal term, but if truly the members of the joint venture have managerial control, then you'd be okay.
Cool. As long as they have control.
Right, exactly.
Okay. Let's see. Does anybody else have any other questions, comments, anything that you can think of that you want us to expand on, or if I used any abbreviations or, you know, industry terms or something that, you know, wasn't expanded on, I'm happy to explain, or we are. Okay, SIDRA investment, so self-directed. So I'm going to spell that one out. A SIDRA is a self-directed IRA investment. So meaning you have an IRA and then you self-direct it. So there's a process to do that. It doesn't just become a self-directed IRA. Are you aware of sponsored deals making a separate class of investors, say C, for allocation purposes?
So not really. I guess that's the best way I can answer that. The reason they may want to do that is for the tax benefits, because tax benefits wouldn't flow through to an IRA investment versus a investor investing with cash. So that would be the reason they may want to, but to be honest, we have not seen a lot of sponsors do that.
I have seen something, and I don't, feel comfortable doing it because obviously I lean on legal counsel for the way that we've done things. I've seen a preferred return, so that's one deal. But I've also seen it structured where there's like Class A, A1 type of investors where some can participate in the cash flow, some can participate in the appreciation. I've seen that in other people's offerings before. Is that a thing?
So it really needs to be checked with a CPA if that is cool to do, whether the IRS will allow those differentiations in distributions. So I'm not comfortable like weighing in on that opinion, but I think it's a really good question for a CPA because there's some differing opinions of whether you can tailor the distributions one way and another way.
Okay. So I guess it's a CPA question.
Yeah.
And we've got several different ones. So if y'all need to ask a CPA that's like a multifamily specific CPA, I've got two, male and female, pick whatever you want. And then, I've got one that does just like foreign transactions. I mean, so you kind of have to have a specialist. And now I've had to meet a 1031 CPA. So yeah, it's specific. So let's see. Got that. Does anybody else have any other questions? This has been awesome. I think not too long. Your presentation was awesome, very informative, but not, ridiculous. And I think they've had some really good questions too.
Yeah, absolutely. Appreciate it.
I'll give y'all another like 30 seconds. And then I did put in the chat, and so did Roxy, to everybody, Cindy's contact information. So like she was saying, if after the presentation you have more questions, you know where to find her.
Very good.
I don't see any more questions. So again, if you guys want to follow up after the webinar is finished, feel free. If you have any questions for me, you can reach me at admin@theapartmentqueen.com. And I really appreciate everybody's time to listen today. And Cindy, thank you for you making time out of your busy day to help my friends and investors understand better.
Thank you for having me. Enjoyed it. And yeah, anyone has any follow-up stuff, please reach out.
Thank you all very much.
Okay. Bye.
Bye.